The collapse never begins with a bang. It begins with silence. Numbers buried in quarterly filings, empty floors in once bustling towers, valuations revised quietly in late-night boardrooms. Analysts now suggest that commercial real estate may be facing a $620 billion decline, not through sudden implosion, but through a slow-motion unwinding that banks are reluctant to acknowledge. And here's what nobody tells you. Real estate crashes rarely reveal themselves in the moment. They unfold in shadows, on paper, and behind the walls of institutions that prefer delay over disclosure. This is where the pattern begins. Right now, the viewer's world is already feeling the early tremors. Rising rents in some areas, collapsing rents in others, businesses downsizing, remote employees leaving office towers half dark at 3 p.m., and banks signaling tightened lending standards in language that tries, unsuccessfully, to sound comforting. According to several economists, today's landscape resembles the opening chapters of earlier crises, but with a modern twist. This time, it isn't homeowners or subprime borrowers positioned at the edge. It's cities, office towers, regional banks, pension funds, and the financial system quietly tied to their valuations. To understand the scale of what's unfolding, we must follow the timeline backward, because the past leaves clues that modern players ignore at their own risk. In the 1980s savings and loan crisis, commercial real estate speculation, powered by loose lending, created a bubble that burst when rates surged. Institutions tried to conceal losses, hoping values would rebound. They didn't. The result? Thousands of bank failures. In 1990, a real estate downturn swept across the U.S., leaving office towers underwater. Banks delayed write-downs until regulators forced transparency. Lending froze, and recession followed. In 2008, the mortgage crisis revealed how complex financial products masked the true risk inside real estate markets. Everyone thought they were safe. They weren't. The danger wasn't what people saw. It was what they ignored. A system leveraged on assets whose valuations depended on optimism. Today, as office vacancies hit multi-decade highs and refinancing cliffs loom, analysts argue that one scenario indicates we may be entering a similar cycle, this time driven not by housing speculation, but by the collapse of the American downtown. Let me show you exactly how this began. For decades, office towers operated under a simple framework: steady occupancy, predictable leases, and rising valuations. Cities grew upward. Companies expanded floors. Banks lent confidently, believing these assets were safe pillars of stability. Loan terms stretched 5, 7, sometimes 10 years, timed perfectly with rising rent cycles. Then the world changed faster than the buildings did. Remote work surged after 2020. Millions of employees relocated or renegotiated where they operated from. Some companies downsized, others abandoned headquarters entirely. Large towers, once full, found themselves half empty. In cities like San Francisco, New York, Chicago, Seattle, and Washington, D.C., vacancy rates climbed to levels economists previously treated as theoretical. At first, it looked like a temporary adjustment, a pandemic-era quirk. Then the bill arrived. As leases expired, companies didn't renew. As subleases flooded the market, rents dropped. The financial math of commercial real estate, built on long-term stability, began cracking. And here's why this matters. Valuations in CRE aren't based on the building itself. They're based on income. Reduce the income and the valuation collapses. Everyone thought the towers would fill back up. They didn't. This is the trap. Buildings worth $200 million when fully leased might now appraise at $100 million or even less. Analysts reviewing recent transactions note declines of 40 to 60% in some central business districts, and that's where the real danger begins. Those buildings serve as collateral for loans held by banks. Declining collateral forces banks to reassess loans, yet many choose not to. Not yet. Here's what nobody tells you. Banks don't have to mark down losses until certain events occur: loan maturity, refinancing failure, or borrower default. As long as borrowers continue making payments, banks can delay acknowledging that collateral values have collapsed. It's legal, but it's fragile, because the refinancing wave is coming. Millions of square feet of office debt are maturing in the next 24 to 36 months. Analysts warn that the refinancing terms will collide with new economic realities. Lower valuations mean lower allowable loan sizes. Higher interest rates make refinancing far more expensive. Borrowers who once secured long-term fixed rates now face terms they cannot afford. At first, this refinancing wave looked survivable. Lenders hoped rates would fall. Borrowers hoped tenants would return. Cities hoped downtowns would rebound. But reality has arrived faster than the hopes. Buildings with 50% occupancy cannot support loans based on 90% occupancy projections. Owners must inject new capital, often impossible. Banks must negotiate write-downs, often undesirable. Cities must absorb the revenue loss, often catastrophic. And this reveals the emotional and financial chain reaction now unfolding. Struggling buildings reduce property tax revenue. Reduced revenue forces cities to cut services. Fewer services make downtowns less attractive. Businesses relocate. Foot traffic declines. Local economies weaken. Crime perception rises. And valuations fall even further. This cycle unfolded in Detroit in the 1970s, Cleveland in the 1980s, and Baltimore in the 1990s. Analysts caution that if this pattern applies to major cities today, the ripple effect could be far more severe, because modern cities rely heavily on commercial property taxes to fund schools, transit, and municipal infrastructure. But the story deepens. Banks know these losses are coming. They see the valuations. They see the vacancy rates. They see the refinancing schedules. Yet many choose not to reveal the full severity of the problem. Some economists argue that institutions may be opting for extend and pretend. Extending loan terms and pretending valuations will recover. This buys time. But time doesn't always fix structural shifts. At first, the strategy looked viable. If the market recovered, nobody would need to acknowledge the losses. Then the data changed again. Interest rates remained elevated. Remote work normalized. Sublease space reached record highs. Borrowers delayed renovation projects. Tenants negotiated aggressively, demanding concessions. The future that banks quietly bet on failed to materialize. The danger wasn't what they saw in their models. It was what they ignored. The possibility that the office sector wasn't experiencing a cycle, but a transformation. Let me show you exactly how this transformation works. The modern economy no longer depends on physical proximity. Productivity doesn't require square footage. Large companies prefer flexibility over long-term leases. Investors prefer liquidity over illiquid assets. Employees prefer hybrid or remote options over commuting into cities. This shift is structural, not temporary. And banks holding billions in office exposure must now confront whether these properties will ever regain their old valuations. Everyone thought the old world would return. It didn't. This brings us to the question that towers above every empty floor in every half-lit skyscraper. If valuations fall by hundreds of billions and banks delay recognizing those losses, what happens when the losses can no longer be hidden? The answer lies in mechanisms that Section 2 will expose in full detail: how write-downs work when they become unavoidable, and what scenarios analysts fear may emerge if the refinancing wave collides with a credit squeeze. Because the danger isn't in the collapse, you can see. It's in the one unfolding quietly while the buildings still stand. The truth about financial crises is that they rarely arrive as explosions. They begin as cracks, hairline fractures hidden beneath the surface, until one day the pressure becomes too much and the structure yields. Analysts examining commercial real estate warn that this moment may be approaching, not because towers are collapsing or tenants are fleeing overnight, but because the financial mechanisms used to support those buildings can only endure so much strain before they reveal what's been hidden. Here's the mechanism. When a property's valuation falls below the size of its loan, the building becomes underwater. Banks holding those loans must eventually recognize the loss. But as long as owners continue making payments, banks can delay the inevitable. This delay is the silent phase of a crisis, the quiet moment when the damage already exists but hasn't yet been acknowledged. To understand what comes next, we must follow the evolution of the system under stress. Commercial loans typically mature every 5 to 10 years. Unlike home mortgages, which can stretch across decades, office buildings must constantly refinance. When valuations rise, refinancing is easy. When rates are low, refinancing is easy. When tenants fill the building, refinancing is easy. But when valuations fall 30%, 40%, even 60%, and interest rates are triple what they were when the loan originated, the financial math breaks. Refinancing becomes impossible. According to some economists, this is where the silent crisis begins to speak. Owners unable to refinance must either inject capital or default. Banks must either negotiate or foreclose. And once these events begin accumulating, the paper losses banks avoided for years start materializing in real time. At first, institutions believed they had time. Time for rates to fall, time for tenants to return, time for downtowns to revive. But analysts now suggest that one scenario indicates the industry may be running out of time. The maturities are coming due faster than the recovery. And this is where the chain reaction begins. When an owner can't refinance, the loan must be reevaluated. This often reveals that the building is worth far less than assumed. A $150 million tower may now appraise at $80 million or less. If the loan is $120 million, the bank must acknowledge a loss. This loss reduces capital ratios, limiting the bank's ability to lend. Fewer loans mean tighter credit for businesses and households. Tight credit slows the economy. Slower economic activity pushes commercial tenants to downsize further. This is the feedback loop, not collapse, contraction. Everyone thought they were safe. They weren't, because the danger wasn't what they saw. Office towers rising above the skyline, banks reporting stable earnings, cities projecting growth. It was what they ignored. The enormous debt hidden within those structures, quietly maturing, demanding repayment at a moment when repayment is least feasible. Let me show you exactly how this trap tightens. Trap Tharker 1. Declining valuations. Commercial real estate is valued based on rental income. With vacancies at multi-decade highs, income has collapsed. Even buildings that look physically healthy are financially unhealthy. And analysts warn that in some districts, valuations may take a decade or more to recover, if they ever do. Trap Tharker 2. Rising interest rates loans. Refinanced at today's interest rates face far higher debt service costs. A building once able to support a 3% rate may not survive a 7% one. The math simply doesn't work. Trap number 3. Frozen transactions. Buyers and sellers are too far apart on price expectations. Transactions slow. Without transactions, appraisers lack data. Without data, valuations remain artificially high. Artificial valuations give banks the illusion of safety, until refinancing forces reality. Trap Tharker 4. Bank exposure. Regional and mid-sized banks hold a disproportionate share of commercial real estate loans. Analysts suggest these institutions could face significant stress if defaults accelerate. A few failures could ripple outward, tightening credit nationally. And now we must confront who pays the price. Property owners holding distressed buildings face losses, but many can walk away through strategic default. Large corporations can absorb write-downs. Private equity can restructure portfolios. But small and mid-sized banks, the backbone of local lending, cannot so easily escape. Their portfolios are often heavily concentrated in CRE, and if losses erode their capital, they must shrink. Shrinking means lending less. Lending less means businesses receive fewer loans. Fewer loans mean layoffs, delayed expansions, bankruptcies. And the cycle continues. This is why analysts warn that commercial real estate could trigger broader economic consequences, not through dramatic collapse, but through credit suffocation. Consider the parallels. In the late 1980s S&L crisis, regional banks tied to commercial real estate collapsed one by one, not because their properties physically failed, but because their valuations did. Losses accumulated slowly, then suddenly. In 2008, the collapse began in mortgage-backed securities, but the real damage came from credit markets freezing. It wasn't a housing collapse alone. It was a liquidity collapse. If this pattern applies to the current cycle, The danger will emerge not from empty buildings, but from empty balance sheets. This is the moment where the future diverges into three distinct scenarios. Scenario 1. The gradual unwind, soft decline. In this scenario, losses appear slowly. Banks extend loans. Owners inject capital. Cities redevelop properties into residential units or mixed-use districts. Credit tightens but doesn't break. The economy absorbs the losses over several years. Analysts argue this scenario is possible if interest rates ease and refinancing terms soften, but it depends on cooperation across institutions and time. Scenario 2. The regional bank crisis, localized shock. Several economists argue that this scenario is increasingly plausible. Regional banks with heavy CRE concentration face write-downs. A few institutions fail. Regulators intervene. The losses remain contained, but credit in affected regions tightens dramatically. Small businesses feel the strain. Downtown districts deteriorate further. This scenario resembles the early stages of the 1980s crisis, manageable but painful. Scenario 3. Systemic credit event, hard break. This is the scenario analysts invoke cautiously. If valuations fall faster than expected, if refinancing collapses en masse, or if a major institution reveals hidden losses, confidence could falter. Banks could restrict lending across the board. Businesses could reduce hiring. Cities could face budget shortfalls. Investors could pull back from real estate entirely. It wouldn't look like 2008. It would look slower, like a dimming, not a crash. A hard break in commercial real estate is not an explosion. It is a freeze. But the most important question remains. Why are banks delaying recognition of losses? Because delay is the last tool they have. Admitting the losses now would force enormous write-downs, reduce capital, invite regulatory pressure, and potentially destabilize the institutions themselves. As long as borrowers continue making payments, banks can pretend the valuations still stand. According to some analysts, this pretend equilibrium may hold for a while, but not forever. Eventually, loans mature. Eventually, payments falter. Eventually, buildings must be marked to market, not to memory. The silent phase will end. And when it does, the consequences may surprise those who assumed stability simply because the skyline remained unchanged. Yet, despite the gravity, the future isn't predetermined. Some cities are reinventing downtown districts with residential conversions. Some banks are restructuring loans early. Some investors are positioning for distressed opportunities. Some policymakers are exploring new frameworks to stabilize the sector. The real danger is not the decline itself. It is ignoring the signals that the decline has already begun. Here's what nobody tells you. A crisis delayed is not a crisis avoided. It is a crisis stored. And the coming years will reveal whether the $620 billion commercial real estate unraveling becomes a controlled correction, or a structural transformation of American finance. Either way, the skyline will not tell the full story. The balance sheets will.